Hello, and welcome back to another lecture series dealing with Chapter 16. Now, Chapter 16 has to do with investments. So, prior to this chapter, we looked at Chapter 14 and Chapter 15. Chapter 14 dealt with bonds, and chapter 14 dealt with stock, and chapter 15 dealt with bonds, right? We were looking at the journal entries that a corporation makes when they either issue stock or pay a dividend or repurchase stock. And we looked at bonds from the perspective of the company, right? Meaning the corporation is going to issue its own bond, or it's going to issue its own term mortgage notes payable. It's going to accrue interest expense, and we're going to pay interest. So we saw all those transactions, right? In this chapter, chapter 16 deals with investments. So as we go through this chapter, this actual chapter actually kind of coincides with us personally, meaning we're going to invest in debt investments, or hopefully at some point in time, we'll have a retirement account or an investment account. And personally, we're going to invest in debt investments or stock investments. So, Chapter 16 deals with corporations that have excess cash, and instead of holding that excess cash, they invest it just like you and I would in either a debt investment or a stock investment. Okay? So, the learning objectives specifically for this chapter, you should be able to explain how to account for debt investments. You should be able to explain how to account for stock investments. And then finally, you should be able to explain how debt and stock investments are reported within the financial statements. Okay? So keep in mind here, we are not booking our own debt that we issue, right? We're not recording our own stock that we issue. We're recording debt investments, stock investments that we purchase from another company, and we hold on to that, or the corporation holds on to that. And the corporation is the client, so to speak, right? The corporation is the one that is entitled to those interest payments. The corporation is the one that's entitled to that principal return, or the return of principal once that bond matures. Okay. Same thing with stock investments, right? The corporation is now the customer, so to speak, meaning the corporation is going to go out and buy stock in other companies. So the corporation is entitled to dividends. The corporation is also entitled to vote, right? Because it's a corporation owning shares of another corporation. Okay. So first, let's look at debt investments, and that's what we're going to talk about just in this video. How do we account for debt investments? Now, why would a company want to invest? Excuse me. Why would a corporation want to invest in another company, right? Well, think about it. If you look at the illustration here, through the normal course of business, right? Corporation generates cash. They use that cash to buy inventory, right? They operate, sell inventory. They collect accounts receivable, and then they turn around, collect the receivables as cash, right? And they start the process all over again. Sometimes a corporation has excess cash. What they do with that is they, just like you and I would, they invest and sell in temporary investments. Okay, so the corporation again is going to or let me rephrase that. Why then would a corporation invest its excess cash? Well, one of three reasons. First, they have the excess cash to do that. Second, they want to generate earnings from investment income. If they have that extra cash and they just hold on to it, it's not getting a return on that asset, right? Which is cash. So why not invest it? And the third reason, and we'll get into this when we get into stocks really, for strategic reasons. Okay, and we'll talk about those strategic reasons in our second video. Okay, so let's look at why why corporations invest, right? So why do they? Well, we know it's because they have excess cash, they want to generate earnings, and they have strategic reasons. Now, pension funds, banks, they actually reinvest, or they invest in debt and stock securities, right? And again, they do that so they could generate earnings, okay? So when we're looking at debt, and we're going to talk about debt investments, right? Debt investments are investments in either government bonds, or they can be in corporate bonds as well, okay? At acquisition, what do? Well, and I would definitely put this in a note card, right? Because this is never going to change. So if you have to do any journal entry that says at acquisition, Corporation A bought X amount of bonds, right? What's the journal entry? We need to debit investments, right? We debit investments at the cost, and all expenditures necessary to acquire those investments are included in the cost, okay? What does that mean? Well, that means that we're a corporation and we have excess cash and we invest in debt, meaning we buy bonds, right? It's acquisition. We need to record that journal entry. We need to include the cost of the debt of the bond, right? Let's just say it's $1,000, okay? We also need to include all the costs and all expenditures that's necessary for us to purchase that debt. So that means things like brokerage fees or maybe commissions, whatever, right? All those costs get included in the journal entry of that investment, okay? Now, at acquisition, right? We got to debit investments and we got to credit cash. And again, we're doing that for the cost of the investment, okay? So what entries do we actually do? Well, we do a recording at the entry. We do a recording, or we record whenever we receive interest. And then we also record when we sell, okay? Very easy to record bonds and whatnot, okay? So again, what are we looking for? We're looking for recording bond interest, right? So we have an example of, or we're going to see an example. We got to do it at acquisition, and then we got to record the interest, right? We got to calculate and record interest values based on the carrying value of the bond times the interest rate times the portion of the year the bond is outstanding. Now, this is pretty much identical to the way we calculated interest expense in Chapter 15, right? The only difference is, from an accounting perspective, we are receiving this interest. We're not paying it out, okay? We also need to record the sale of the bond, right? What do we do when we have to record the sale of the bond? Well, we credit the investment account again for the cost of the bond, right? We may have gain or loss whenever we sell the bond, right? Any differences that we have between the net proceeds from the sale and the cost of the bond, okay? This will become a little clearer when we do work on an example, which here we go. We need to account for debt. So, Cool Corporation acquires 50 Doan Incorporated 8% 10-year $1,000 bonds on January 1st, 2017. The cost of this is $50,000, okay? We need to record the acquisition of the bond, right? Very easy to do. Debit debt investment, credit cash for $50,000, okay? Now, they tell us that this bond pays interest, right? 8%. It's a 10-year bond, okay? The bond pays interest annually on January 1st, okay? So if Cole's fiscal year ends on December 31st, we need to prepare the journal entry to accrue interest earned by December 31st, okay? Now, if you're thinking back about chapter 15, right? It's a little different here, right? Why? Because we are the ones receiving the interest. So we need to accrue interest. We've earned it. We need to accrue it, okay? So that's why whenever we're accounting for interest, we are going to debit interest receivable. Interest receivable is an asset. It's very similar to accounts receivable, right? Accounts receivable said we sold something, somebody owes us money, or we performed the service, somebody owes us money. Same thing with interest revenue. We earned interest revenue. We're entitled to that. We'll get paid later, so we need to accrue it. We debit interest revenue for $4,000, and we credit interest revenue for $4,000. Okay. If you're concerned, how'd you calculate $4,000? Again, because this is annually, or the interest is paid annually, we take the face amount of the bonds times the stated rate, 8%. Okay, that's how we got the $4,000. Now, once we actually receive that cash, right? So on December 31st, we had to accrue it. We earned it. We're not going to get it till literally the next day, right? But because it's a year, it's a new accounting period, we had to accrue it in the prior year. This year we can show that we actually received the cash, okay? So Cole reports interest receivable as a current asset on the balance sheet, right? We already talked about that. It's just like accounts receivable, very similar, right? We're going to report that interest revenue that we have. That's actually reported as other revenues and gains, okay? So on January 1st, we get an interest check from Dawn or whoever. We need to record that. What do? Well, we already accrued the interest. We already acknowledged that we had a receivable, interest receivable. That interest or that asset or that agreement that we were owed money is now being satisfied. So we need to decrease the interest revenue or interest receivable, and we need to credit cash, right? So credit cash $4,000, decreased interest revenue with a debit of $4,000. Now, let's assume for a moment that Cole receives net proceeds of $54,000 on the sale of Dawn Incorporated's bond on January 1st, 2016. What's going on here? Well, Cole has the bond. They're entitled to the interest. And then for some odd reason, Cole says, you know what? I don't want this bond anymore. I want to sell it, right? The cash, or we'll say the sales proceeds from selling this bond was $54,000. Cool. We need to prepare the journal entry for the sale of the bond. Very simple. What are we getting? Well, we're getting cash. What are we given? Well, we're given that debt investment to somebody else, right? Somebody else bought it off of us. That's okay. We compare the cash proceeds that we received, $54,000, with the carrying value of that debt investment. Well, it's $50,000 on our books. Debits and credits do not equal, so we must have had a gain on sale of debt investment. That's our new account that we need to have. Okay, so we're going to debit cash for $54,000, credit debt investment $50,000, and credit gain on sale of debt investments for the $4,000. Okay. Now, what if there was an event that was related to an investment in debt securities that did not require a journal entry? Okay. So what we're looking at here is an event that has to do with the investment in a debt security that doesn't require a journal entry, right? Well, we already know when we acquire the debt, we have to make a journal entry, right? Whenever we receive interest revenue from that debt investment, we have to do a journal entry. Whenever we sell that debt investment, guess what? We have to do a journal entry. So, a change in the name of the firm issuing the debt securities, that does not require a journal entry. Okay? Very important. When we sell the bond, the gain or the loss on sale has to be the difference between the net proceeds and the cost of the bonds. Okay? Very important that we understand the difference between the selling price and the net proceeds. Basically, what we're saying here is the net proceeds. I apologize. Bear with me if you hear the dinging. Sorry about that. I need to turn on the do not disturb. Okay. Back to the difference between sales and net proceeds, right? The sell price is what we get for it, okay? We sold a car for, excuse me, or we sold a bond for $10,000, okay? The net proceeds include the cost of selling that. So let's just say we sold a bond for $10,000. Our brokerage firm charged us $50 to make that transaction. What are our net proceeds? Well, it's the sell price that we get minus those costs. Those costs, in this example, is the $50 brokerage fee. So what's the net proceeds? $950, okay? So what we need to do then is compare net proceeds to the cost of the bond or the carrying value of the bond. I'm not going to walk through these, do it. You can do that on your own. In fact, I encourage you to. The answers are actually, I believe, in the book. And they even give you the answers here on the slide as well. But what I want to do now is kind of switch over or switch to another video. And we're going to work through a number of exercises dealing with making debt investment entries. When we come back, or after that, we'll get into stock investments. So don't worry about that right now. I just want to focus in on the bonds, right? And we'll see we'll see some examples of when do we do the journal entries, how do we calculate the cost as well, or how do we calculate the net proceeds that we receive, okay? So tune back in for that one.